All right, all right, all right. We are live Monday, YouTube live, question and A with a mortgage broker. Check out the new sign. I'm pretty stoked about it. Just came in today. They just mounted that puppy. Got the wall behind me painted. I know last week we had the different colors here. And so thank you to everybody who joined in on voting. All your votes mean about as much as mine, next to nothing. Wifey decided on the grade that she liked, and here we are. So appreciate you nonetheless. Lots of different things we can talk about tonight. One thing that seems to be pretty, I don't know what the right word is for it, but nobody wants to admit the rates have gone up. And I just, from a human psychology perspective, it interests me, right? Had a client today tell somebody on my staff, when we showed them like a 3.125, that they expected rates to still be in the twos, and that rate seems really high. And so it might be a deal breaker. They might be looking elsewhere. And sure, you can still get rates in the twos, depending on your scenario, how much down payment, what your credit score is, and all that stuff. It might cost you half a point, might cost you a full point. Everybody's different. Every scenario is different. But I think where a lot of people are being misguided is that nobody on my side wants to admit the rates are up, because then, I don't know, they feel like it's going to scare people away. They feel like they're not going to sound as competitive. I don't know what the real reason is. But like I shared in some of the videos I put out last week, all the marketing folks that are calling me, I let them call me. I don't put myself on do not call lists. I want to hear what people are saying. They're telling me that rates are down. It's a great time to refinance. And I dug in. I think we shared. I'm gonna record more of these because it's so much fun for me. I had a buddy of mine in the office, and I had the phone on speaker, and this guy kept asking me questions, and he wouldn't answer mine. And I'm like, are rates down? Because I just refinanced about a year ago, and I'm telling him I have multiple properties. I'm telling him I might be interested in refinancing, but I don't know because I refinanced a year ago and our rates down. And he's yeah. And then when I follow up, I go, oh, they are? Like, what would I be able to get better than the rates I was getting last year, like 2.75? Yeah. And he just, everything I asked, he said yes. He's trying to get me to talk to somebody who might be able to sell me. But the piece that I wish I would have had recorded was instead of answering my question, he'd ask me a new question. And so he's trying to get me to say I want cash out because I've got a 2.5% or something on my primary. And so I said, I got a 2.5 unless I can get a 2% or lower. I don't know if it makes a lot of sense. And he goes, he kept talking about my backyard. And he says, do you have a backyard? Do you have a backyard big enough for a pool? And when he kept saying backyard, I goes, is the backyard where the rates are at? Anyhow, you had to be there. I thought I had something else written down, but let's jump into some of these questions. Let's do what we do best, which is basically just start having a conversation. You've got questions. I've got answers. Some of these will lead to more questions. Some of these will lead to me kind of figuring out what kind of the feel is out there. I'm glad I hear from Riley, got a 3.125 and was stoked. You should be. Super low interest rate, right? I think, for anybody who's just like, oh my gosh, 3.1, that's crazy. They weren't going to be at 2.625 forever. And August 2nd was the beginning of the end for amazing interest rates. I talked on Mike Zuber's channel, or I might have talked here about between August 2nd and mid-October, most rate sheets, most scenarios, wherever you were at, you went up 3/8%, maybe even 0.5%. So from 2.625 to 3, 2.625 to 3.125, somewhere in there. Is the 2.625 still available? Yes. Does it cost 2 points now? Yes. So anyhow, that's that. Zeta, thanks for joining. Good to see you here as always. What's new this week in the mortgage business? I'll tell you something that's new. I made a video, I think it went out earlier today. It was just a YouTube short that we're able to, a couple of weeks ago, I let folks know we're able to do up to 625 on a conforming loan. Just today, October 25th, lenders let me know, hey, listen, we're ready to take the high balance stuff. So high balance counties in California, San Mateo, Santa Clara, San Francisco, Los Angeles, Orange County, those counties that were at 822, 375. What's the new number? 937, 500. I'm able to go up to 937,500 on a high balance conforming loan, not a jumbo. That's a crazy number. For other counties that aren't in that, high balance, that they're probably going to be like Sacramento County is probably going to be high sixes. Placer, El Dorado counties will probably be high sixes. Whatever, let me see. Right now, Sacramento, Placer, and El Dorado are all 598. If those went up 14%, maybe up to like 681, that's probably where it's going to land, 680-ish. Anyhow, I digress. Jeanette, hello. Thanks for joining. Kevin, as always, thank you for joining, brother, from Florida. Good to see you here. Lamont has a question, and that's what we're here for, to answer questions, see what we can do to help you folks be empowered through mortgage education, right? I want this year's income taken into account. How can I do that? Got my pre-approval in January instead of December. It depends on what type of income you have, Lamont. If it's self-employed income and you're like, I want what I've done in 2021 to be taken into consideration, it would be a thing where you're going to have those taxes filed. So if it's any sort of W-2 income, you should be able to use it unless it's hourly or variable. If it's like W-2 salary, as soon as you've got that new income, we can use it. So I guess I'd have to know what type of income you have to better answer that question. But, depending on whether it's W-2, whether it's self-employed, and if it's W-2, is it, hourly, salary, variable, commission based, any of that stuff is going to be different. So let me know. All right. All right, Lamont, W-2 hourly. It's always going to be an average, always. And so you've got, if you're working full time and you've got a new hourly rate, the problem with hourly is like, if you don't have exactly 40 hours every single week, then they're going to take a 2-year average, which can really hurt you. If you've gone from $15 an hour to 17 to 20 to 21, you don't want to take a 2-year average. It's going to be lower. But if you got an increase in pay in January and you've been making $21 an hour and you've worked 40 hours every single week, the problem is they're going to look at your year to date. If it doesn't line up for, 40 hours every single week, they're going to resort back to that average, which is going to hurt you. Wish I had better news. All right. If Tecker popped in at 5:30 and asked a question before we even started talking about short employment history. And let me pull up your first question so we can answer this one. Trying to get a pre-approval. Your employment history should be at least 2 years. Everything else was fine other than your employment history. There's not really a lender that can do anything about, the conventional guidelines or FHA. All the guidelines basically state 2 years of employment. If you have schooling and you can say, look, I went to school for this specific trade and I can show you my transcripts from school, and now I've been working this job for a year, then you can use less than 2 years of employment, but you got to have something to cover that 2-year period. A year of school, year of work, 4 years of school, 6 months of work. A lot of times, if you go to school for nursing, you can go to school for 2 years, 4 years, come out, start the nursing program, and we know what you're going to get paid right from the beginning. We can use that income right away. So, yeah, that's really the only way to get around that. There's not any lenders will say, okay, we work with somebody who's only been employed for 9 months, and they like it's a Fannie Freddie rule. So the government agencies that are buying these loans from everybody who was originating them, it's their rule for 2 years. So nobody can really get around that. Eric, thank you for the kind words. I appreciate it. I'm having fun, man. I'm gonna keep doing this because I enjoy doing it. I feel like it's helping people. I continue to get inspired from people that thank you so much. Watched the channel for 6 months, bought a house in Tallahassee, wherever the heck you were. And if I was a small part in helping that process be easier, less stressful, when the borrower be more educated, I'm happy to help. So you have an FHA loan under your name only. Can your spouse get an FHA loan under her name and I co-sign? Sure, except for that FHA loan has to be a primary residence. So this has to be a house that you guys are moving into together. And the fact that you have an FHA loan now won't affect your ability to co-sign on her FHA loan, as long as it is, like I said, primary residence that you guys are moving into. So you guys couldn't go try to buy a place that's anything but a primary residence. Getting my electrolytes in, making sure I can survive this crazy mortgage world. All right, what else we got? What's going on in the mortgage world? What's going on in the real estate world? What's going on in I'm talking to agents who are telling me they're seeing some softening. More listings coming on. The ones that are on are staying a little bit longer. I would love to hear what people around the country are hearing. So I think maybe, we've only got about a dozen people on here so far, but let me know whereabouts you are. I know, Zeta and Kevin and some of these folks that are on here all the time. I know where you guys are from, but everybody else, let me know where you're from and what you see in your real estate markets. The national news says mortgage inventory is slightly down, but I think that 423,000 compared to last year at this time, 550,000 for the same week. So we're down 23% inventory wise for this same week. What? And then down 54% from 2019. Wow. Inventory peaked in early September. That's Altos Research. That's some interesting stuff right there. I don't know. What's up, Paul in the 916? How you doing? Good to have you here. Do lenders consider authorized user accounts when pre-qualifying for a loan? Whatever shows up on your credit report, which authorized user accounts will, which means they can help you or they can hurt you. If you're an authorized user on a card that's got a $10,000 limit and there's $9,984 charged on that, it's going to pull you down. So what happens is, I'm no credit expert, but there's plenty of expert credit folks that I can refer to. Taking yourself off of some of those authorized user accounts when they're pulling you down is sometimes the play, or putting them on. All right. Liberty Returns is in northern Utah. Prices dropped in September. Cool. That's good to hear. I've got about 96 or 98 pre-approved clients who are fully pre-approved and ready to roll that want to see things getting easier. They want to see home prices flatten. But I don't know what we're going to do with inventory slowing down. I don't know. Maybe it's coming. I feel like it's coming. I feel like there's a lot of people that wanted to sell, didn't do it in time, and now they're like, okay, now we're going to sell. All right, Eric. Great question right here, my man. Is there a big difference in interest rate from second home and owner occupied? Is there any different requirements to qualify? What's the lowest you can put down on a second home? Well, first I want to clarify second home. If you're talking about what we in the mortgage world consider a second home, you're talking about what's kind of like a vacation home. And for me in Northern California and Sacramento, a vacation home is Santa Cruz, something on the coast, or up in the mountains, it's Truckee or Tahoe or somewhere up there where I might take my family 4 weeks, 6 weeks, 8 weeks out of the year when we stay in that quote unquote second home, which is different than an investment property. And so the three types of properties for us lenders: primary home, second home, vacation home, or investment property. And so if I'm answering your question about second home, you can buy a second home. It's got to be in a location where it makes sense to have a second home, vacation home. And you can do that with 10% down. The terms are very, very close to primary residence. If primary residence right now is sitting at about 3%, and an investment property is sitting about 3.5%, and we're talking about not paying points, we're talking about just the par interest rate. Investment home is 3%, 3.1 maybe, very close to what a primary would be. And so 10% down on those. If you're talking about investment property, some lenders will do 15, most lenders want 20, and you really get the best terms at 25% down. And so if it's a true investment property where you're going to buy it and rent it out to renters, then that's going to be considered investment property. So hopefully that answered your question and more. My World in View. Thanks for joining. I recently refinanced my home in February, rate locked from November at 2.5. Want to do some renovations. Given the rates being higher, would a cash out refinance make sense? Probably not. And it depends on how much you owe. But this is my general advice to folks who are looking at a cash out refinance is you've got to take into account, let's say, I'm just throwing random numbers out there. Let's say you owe $300,000. For you to take out $60,000 and let's say a cash out refinance is 3.25%, you're not only paying 3.25 on that $60K you're pulling out, but you're paying an extra 0.75 from 2.5 to 3.25 on the 300 that you owe currently. And I'm just making these numbers up. Maybe it's less, maybe it's more. I personally don't think that's a very good idea. You might be better off going out there and getting a home equity line of credit, keeping the 2.5 on the first 300, paying 4% or 5% on the 60, and have a game plan to get that 60 paid off, right? And the same thing goes for people that have a 4%. If you have a 4%, cash out refinance all day. Your rate's coming down and you're pulling cash out. And so in your case where your rate would be going up, there's probably not many cases where it makes sense. There are some where it does. And in some cases, like the rate doesn't matter. If you got a 2.5%, you got 125,000 in credit card debt, and you've got 900,000 in equity, then maybe it makes sense. Or maybe you only owe 82,000. You owe 82,000 and you could pull out 150 and there's a business opportunity or there's an investment opportunity that's going to get you 12% returns. Okay, maybe that makes sense. But just to do renovations, you probably want to secure financing separate from that 2.5% and leave that 2.5% alone. All right, Zeta. Massachusetts. In your small town, not seeing much in the way of inventory, and they're selling very quick. A lot of land for sale, but it's expensive. Land's expensive. Building is expensive. As an investor and going to some of these investor meetups I go to, I'm seeing some crazy stuff just with like what people are not only thinking they can sell a property for or wanting to sell a property for, but what the stuff is selling for. On the investment side, it always kind of interests me to see, deals you'll look at and you're like, nobody in their right mind would look at this and think this is a deal. And then it sells for that price. But, who knows? Maybe real estate will have another 16% home price appreciation and all look like the dummy that didn't buy some of the deals that I'm looking at and thinking are not great deals this year, which that's another topic, which is an interesting one. Who said that? Who talked about 16% home price appreciation next year? Somebody did. It was in some article last week. That seems like a stretch. That seems wild. If that happens, it's going to be tough for a lot of people. All right, Matthew, I'd be happy to, man. That's Leo Trim. I don't want you to be sad, man. You can get through this. Stay strong. You're amazing. I don't know what exactly you're going through, but I can promise you, all of us go through things one time or another. So I hope I pronounced it right. Leo Trim, man. Keep your head up. All right, Matt. Hopefully that helped, man. Remy Jules, I appreciate the heck out of you, man. Thank you for the support, dude. I just trying to do my best to spread good education, and I continue to be reminded that it's needed, right? Because I'm reading stuff that's online. I'm fielding calls from people who are trying to sell me a refinance. And I'm telling you, like, there is some bad information out there. And if I could save one person from doing a refinance that doesn't make sense, if I can help one person have one less sleepless night during the loan transaction, then I'll be happy, because I've been blessed and highly favored in a lot of different areas of my life. And the mortgage business has blessed me. And if I can give back by adding value and helping folks, even ones that, truth be told, aren't a client of mine, will never be a client of mine. That's the cool part about the internet, right? I can help folks around the country. It's a great question, Eric. 60% is the sweet spot. You can look at it as like up to 60%, then 60 to 75, and then 75 to 80. Those are the three buckets, if you will, of different pricing. And that 60%, with the rates this low, it's not a huge difference. Let's, for the sake of argument, let's say you're doing a refinance on your primary residence, and at 60% loan to value, the rate is 2.99. At 75% loan to value, you're 3.125. And then at 80% loan to value, you're 3.25. And, with any of those, you could pay to lower it. You could pay a point or pay 2 points if you wanted to. But if you wanted to just look at their par rates with no points being paid, they might be all an eighth apart, right? Not a huge difference. And this is for sure on cash out. On cash out, the beautiful thing about this, because I've priced 1 bazillion loans in my life, and what you'll notice is if you've got a cash out at 60% loan to value, that big fat 40% worth of equity is gonna, the lender's gonna grant you some grace. I've done like scenarios, cash out refinance for 685 credit score versus 740, and it's not that big of a difference. If you've got all that equity, you're still going to get good pricing. Then again, Eric, you go to the next bucket, 60 to 75, slightly worse. 75 to 80, if you're doing cash out on your primary, it's going to be the highest rate up there because it's the most risk for the lender, right? And when you're going up to 80%, the lender's like, okay, you want the max, you're going to have to pay a little bit more. It's a great question, Remy. What happens when a lot of the areas around you are too high to invest in? You look elsewhere. That's probably something that applies to me because I'm in California, right? So a lot of people be like, man, I looked in Sacramento, I looked in the surrounding, Elk Grove and Natomas and Folsom and Carmichael and Citrus Heights. I mean, like Sacramento and surrounding, you're not going to find a lot of areas where a lot of deals make sense. So one, you niche up and dig deeper and tell yourself like, all right, not a lot of deals to be had, but I know if I can find a duplex where I can, rehab and raise rents, or if I find a 2-bedroom house that I know I can make into a 3-bedroom with a little bit of renovation, and I can rent that for this number. You either got to get more creative in the market you're in, or you branch out to another market and you say, okay, an hour from here in Yuba City, I can find stuff that's 40% cheaper. The rents are only 15% less. And so when I start doing, my numbers, I start crunching it as a rental property, it might make sense. That's my best advice regarding that, because, there's going to be areas like that, especially if you're in a place like California where real estate is rather expensive comparatively. Your follow-up question was if you have any grants that I recommend for small businesses. I'm not really that knowledgeable about grants, but I'm sure if you popped on to SBA, maybe the Small Business Administration has information on grants. They did a bunch of stuff with PPP and different things for that's where I'd start, sba.gov, and then go from there. All right, Zeta, you think about retiring? Zeta wants to know if Florida is the best place to retire. I've heard a lot of good things about Florida, so maybe. I have never been to Florida in all my life, so I don't have a very good knowledge base to really speak on this. Maybe somebody else in the comments can tell you about Florida. It seems to be a pretty popular place to retire. I don't know if it's the tax laws or something else, but quite a few folks flock to Florida for their sunshine and beaches and for retirement life. All right. Tanisi Adams. We're in the process of a cash out refi on our primary at 3.625 and had to cancel our application. We still want to do the cash out refi and are now able to do so. When do we attempt the application process again? Whenever you want. I mean, there's no real set timeline on when you can start a new one if you've canceled out an old one. So let me know if we can help at all. Depending on your credit score, 3.625 sounds a little bit steep for a cash out refinance. Sounds a lot steep. Let's get to our first pricer of the night. Why don't we? I'm just going to do this on the sidelines. You guys all sit tight. I want to see I want to see where we'd have to be 3.625. Maybe it's a small loan amount, right? That's my guess. 3.625 would have to be on a small loan amount. On a bigger loan amount, we'd have better rates. I'm going to call it 225 loan, $300,000 value, cash out refinance. I'm just going to leave the credit score alone. Cash out. I'm going to click a couple of my favorite lenders. Oh, an arm. Nobody wants an arm. I forgot to unclick the. I do not want to see adjustable rates. Oh, maybe I do. I'm going to go lower in credit score. Where the heck are we getting a 3.625? Nobody's going that high, are they? These arms. Maybe 680 credit score, going up in the 3.625 range. Yeah, I mean, I think you can start it right away. I wouldn't see any reason for waiting. If you already gathered documents for the first time around, you probably have all that stuff, or the lender has all that stuff. So I would, I'd go ahead and get rolling. Thank you for the super chat, Tanisi. Am I saying that right? I appreciate the heck out of that super chat. Correct in that you have to use the mid score, the lower of the two mid scores. And so in your case, let's say you had a 702, a 712, and a 725. 712 is the middle of those two scores. And your husband might have had a 681, a 685, and a 701. 685 is his mid score. The lower of the two mid scores is what you have to use. And so, yeah, that sounds about right. 680 cash out refinance. If it's, 75 or 80% loan to value, 3.625 sounds about right. If you want, I know a guy. We just want us to take a look, let you know if we can give you a second opinion. All right. Thanks again for super chat. I appreciate it. My kids think I'm super cool for getting super chats. Nyaran, any chance Sacramento will be added to the list of high loan balance limits? That 937,500 in 2022. The answer is no, because Sacramento is, so 548,250 was the 2021 limit. And then each county had their separate limits for high balance loans. Sacramento, El Dorado, Placer, those counties were 598. And then you had these super expensive counties, Marin, San Mateo, Santa Barbara, Santa Clara, San Francisco, Orange County, LA County. Those are 822, 375. There's other counties that were in between with different loan limits. The highest of the high are going to 937,500, like you said, Nairan. Sacramento is 598. They're going to probably go to about 680. They're going to see a 14% increase or whatever when those limits are announced. They're not going to go as high as the San Mateo, Santa Clara, and all those counties, because there's not, that those were already at 822 and they went to 937. We were at 598 in Sacramento. We're going to probably go to 680-ish. I skipped some questions. My bad. Let me get back to some of these I missed. I don't want to miss anybody. Eric, if owner occupied loan, is there a maximum number of people that could be on the loan? Can I have family cosign and not on title and not moving in? You can have non-occupant co-borrowers. Do they have to be on title? Non-occupant co-borrowers. I'm thinking out loud. Co-borrowers. I'm going to get back to you, Eric. Shoot me an email, matt@mattthemortgageguy.com. I should know that one, but I'm not going to pretend, because sometimes I say stuff out loud and then people hit me up and be like, hey, you said 80% cash out owner occupied duplex. And I go, whoops, I said it out loud and I shouldn't have, because I was thinking of rate and term, or I was thinking of a purchase, whatever the heck I was thinking. If I don't know it, I'm not going to say it out loud. And so in that case, I'm fairly certain they have to be, but I'm not positive. So I'm going to get that question answered. I could probably pop a text over to my processor. He's the all-knowing. He should be able to help me out. So let me see if I can send that. Let's look at the next question. Hey, what's up, buddy? If I've got non-occupant co-borrowers on a loan, do they have to be on title, or they can be non-occupant co-borrowers and not be on title? Thanks, brother. See, let's see if we get an answer to that one. All right, closed on a condo 2 weeks ago. Curious about your general thoughts on condos as an investment, first-time buyer, 3.201 interest rate, living in it for now. Renos being made soon. I'm not a huge fan of condos. It doesn't mean that all condos are a bad investment, or doesn't mean that yours is a bad investment. I've seen plenty of people who have crushed it with condos. I know people that own dozens of condos. I know investors that have come to us and I'm like, all you do is buy condos, 24 condos. And so, not a bad thing. That's a smoking interest rate. Sounds like you bought it as a primary, you're living in it as a primary, and then you're going to turn it into an investment. So, you're going to have a smoking mortgage on it. I know that. It's going to be treated like most any other piece of real estate. If you have a good looking 30-year fixed mortgage on it, and you've got good tenants in place that are paying the rent on time, that's either, providing some cash flow or at the very least breaking even, I think most people would be surprised if they looked at the 10-year, 20-year picture on real estate, just factoring in debt pay down and appreciation. Just factor 4% appreciation. Not every year is going to be 15, 16, 18% appreciation. But if you take something that's worth $300,000 and appreciates every year 4%, I don't know what that is on the 10-year time horizon, but you take that number, which is 400 and something, I'm guessing, maybe more. Yeah, probably in the mid 400s after 10 years. Then you also take, the fact that you're paying it down, or your tenant's paying it down, and maybe you only owe 220, like whatever the down payment is. And then you look at that spread, the net worth, right? 450 versus 220, or whatever that number is, that $230,000 return. It's some good returns, even on a break-even property. Ideally, it's providing some cash flow. And at the very least, it's providing enough cash flow to pay for maintenance, repairs, and all that stuff. So anyway, like, it can be good. I'm not a big fan of HOAs. A lot of the stuff in my area, $300, $400, $500 a month in HOA dues, which don't really provide much value. Sometimes condos will go down in value faster in a declining market, and kind of increase in value slower in an appreciating market. So, that's some of the reasons, I guess, where I probably shy away from them. There's no stupid questions, Jason. Don't start off by saying stupid question. There's no stupid questions. When choosing to cash out, better stay in the FHA if the rate monthly payment is lower than conventional? No. This is a great question because this probably is going to help some people. So I appreciate you asking this question. FHA is going to charge you on a refinance, on a purchase, 1.75% upfront. And so that 1.75% on a $400,000 loan is $7,000. Just bam. Upfront mortgage insurance premium. Just going to be slapped into your loan. So maybe you get a cheaper rate, but one, you've got that to contend with. Two, when you're doing cash out, you're doing it on a property where you've got a ton of equity. Otherwise, you wouldn't be able to cash out. And so is that lower rate plus mortgage insurance still cheaper than your conventional loan where you're not paying mortgage insurance at all? I would guess that even if that FHA rate is 2.375, a 3% or a 3.125 without mortgage insurance is going to be very close payment wise, except for you're not going to pay the 1.75 upfront mortgage insurance. And that interest that you're paying is tax deductible. The mortgage insurance can be, it's not always tax deductible. So look at all that stuff. I don't think for people with a lot of equity, FHA makes a lot of sense, because you're paying mortgage insurance because you choose to. And you got to, look at the blended, quote unquote rate. Yeah, the rate's lower, but the rate plus mortgage insurance, is that lower conventional rate? My boy Joey, that's looking nice, huh? New paint back there. Got the new sign. I don't want to screw up this good angle, but wife's got some of the baseball picks up there. What else we got? That new little shelf. My desk is dirty, man, but it's cool. All right. No more office tour. Got the whiteboard, got the TV. We're still a work in progress. Look at that. Wifey picked that up at Home Goods. That's bamboo right there. This is this big bright light. Bam. I still don't know how to work that. I think I'm doing it right. I don't know. Oh, now I knew I was going to screw up this angle where I got the Matt the Mortgage Guy in the background. Boom. That thing's cool. It's like acrylic. It's like a thick plastic. Thanks, my man. I had to give you the quick office tour since you brought up the paint and the office. Oh, heck yeah, I tell my kids. I tell them I'm a YouTube star. I'm pretty much like Mr. Beast. I'm the Mr. Beast of mortgage. Oh man. If you don't follow Mr. Beast, you should. It's not just for kids. That guy is doing great things. Happy to. Yeah, send it over our way. And really, a lot of times people send me this stuff. I'm not trying to steal someone's business. If you're working with a local broker in Tennessee or in Georgia or in Texas, I'll just look at it. And a lot of times I'm making people feel better about their decision. I'm saying, yes, this looks right. 3.625, only charge you have in box A is 1055. That looks good. All this other stuff is third-party fees. That's not anything that you can really find cheaper, better. So you're good. Proceed. And I think that that's valuable because even folks that work with us, I understand, I tell you it's a good deal. I'm the guy selling it to you, right? Of course I'm going to tell you it's a good deal. You take it somewhere else, I go, oh yeah. The guy's a broker. He's getting a great deal. It means something. So feel free to send it over to us. Matt@mattthemortgageguy.com. Everybody else that didn't send a $10 super chat, I can't review yours, but Tanisi, I got you. That was my attempt at a funny joke. I'm happy to help everybody out. Lucerne. Should I believe my mortgage broker word of mouth? He has promised me to get jumbo loan at 3%. It's been 25 days since the contract signing agreement, but I still don't have a loan estimate. That's my YouTube shock face. You're 25 days in and you don't have a loan estimate? I'd be afraid. That's not good. Yeah. you should have a loan estimate. I don't know what else to say about that except for that ain't good. Jeanette, how are you? I'm doing good. You know how like it's good to be honest with people? People always say I'm doing good. I am doing good, but I got to be honest with you. This happened at my house today. See that hole in the ceiling? My roof was leaking because Sacramento's had some crazy weather and the roof fell in. So it was a stressful day, but still a good day. I got a response. When they're on the loan, we got to have them on title. They can be removed from title after close. That's what my processor said. I don't know if he's 100% sure. But that's what he said. Okay, back to your question, Jeanette. I'm sorry. I got sidetracked there. How are you? I'm doing well. Blessed and highly favored. If I buy a duplex, what type of loan should I get? FHA, 203K, or conventional rehab? I think what you're asking is one of those two. You're not asking like, should I get an FHA or a 203K or a conventional or a rehab? You're asking like the conventional rehab. You know, what's that one called? Not home ready. Home something. Gosh, the home style renovation? No. The conventional product for that renovation loan has got a name. I can't think of it offhand, but or an FHA 203K. I don't have a ton of experience with either one of those loans, really. I've seen the 203K used more often. It doesn't necessarily mean it's any better, but it's just a more commonly used product. My problem with it is you have to use the FHA approved contractors. I've seen it be more expensive. I've seen it take a lot longer than anybody anticipated. And not many people come back and go, that was awesome. I can't wait to do that again. More often than not, it's like, that was a pain in the behind. I wanted to do some things they wouldn't let me do. I thought that, you know, they might have charged me more than I think I could have got had I not had to use one of their contractors, that kind of stuff. So with all that being said, I'm not sure of the answer, but maybe you buy something with a conventional loan or an FHA loan that just needs some cosmetic work and you finance that separately. That way you get a really good loan and you don't have to deal with any of these funky products. Just a thought. Food for thought. All right, Eddie True. This is a question that I get more often than I expected to receive it. How does a loan recast work? Good news, Eddie. If you go to my channel, let me take a look-see. Mortgage recast. What is a mortgage loan recast? That is the name of the video I made in March of 2021. It explains it in detail, but essentially, you say you're thinking about putting 3.5% down. So you buy something at 300,000, you put 3.5% down. So that's what's that? 10.5. So you have a 289,500 loan. After you close and you sell your prior home, you throw that 100,000 in net proceeds at the new loan, and then you apply for a recast. Most lenders will do it. They charge $150 or $200 one-time fee to do a recast. They're gonna take that new balance, 189,500, because you've applied 100,000 to it, and then recast that over 30 years. So it's going to lower your payment because it's going to, now look at the amortization schedule with $100,000 less to pay off, right? So people do that when they're buying forward. And maybe with putting a smaller down payment, it's going to make for a payment that's not very comfortable for them. So like once I sell this house that I'm selling, take that money and throw it towards this. I want to recast it to get into a more comfortable payment. That's essentially what it is. Watch that video. It's a good one, I hope. Yo, Matt, I had a few after a productive day. You're the shit, along with the other big names I learned off from YouTube. That's the cool part, man, is I've learned a lot of good information off YouTube. I mean, I would probably be, if I think about college education versus things I've learned off of YouTube, they're probably neck and neck. I mean, I went to a 4-year university. I got a degree in finance, and stuff I've learned about business from Alex Hormozy on YouTube. Stuff I've learned about personal finance from Graham Stephan and Meet Kevin and the like, Andre Jick. I would like, what's going to happen to universities in the future when like access to great information is available by opening YouTube? I think that's went off on a tangent. I mean, it's something to think about, right? YouTube University. I'm surprised that YouTube hasn't just done that. Just branded something YouTube University and allow creators to put content somewhere. And then, I don't know, I guess creators can create their own courses. Speaking of, where did this thing go? I've got a course. Mortgage 101. There it is. I never share that link. It just fits so naturally right there. It's like, why not? That's the teachable link. If you want to go buy a course, I don't even remember what we're selling it for. 97, 47, 97. Go check it out. Yes. Check out Mr. Beast. He's cool. Mas Administrator. Hey, Matt. If I'm going to use a conventional loan to purchase a small vacation home in California between 100 and 150,000 with 20% down, is it subject to higher rates due to lower loan amount? Yeah. And what happens too is, the honest truth of it is, lenders will have, let's say lenders make 1.5% on a loan. So they write a $400,000 loan and they get $6,000 from that. Pay their staff, pay, payroll taxes, pay whatever, and then, keep the profit, right? If a $100,000 loan or an $80,000 loan comes across their desk, 1.5% of that, let's call it $80,000 loan, is $1,200. They'll have a minimum with that lender of $2,750 or something like that. Because I mean, keep the lights on, pay your staff, do all that on a loan. Like, you can't do a loan for $1,200. Most people can't and actually turn a profit. So they'll have that minimum of $2,750. So what that means is, like, instead of 1.5% being built in, you've got to have pert near 4% built in to the loan, commissions wise, right? Or maybe that's 3.5, right? You want me to price it? I'll price it. Let's price it up and see. 20% down. All right, purchase. We're going to call it a second home. You call it a second home. Purchase price, let's call it $150. That's still going to be an itsy bitsy loan. $150. And it's 20% down. The thing about these tiny loans is a quarter difference in rate when you're borrowing 120. Who freaking cares? It's a nice way of being like, Yeah, so you're gonna pay in this case about 3,625 ish. This is such a small loan. You can either say, hey, for a point, I can go down to 3.375, and a point in this case is only $1,200 because $120,000 loan, or 3.625 isn't that bad, and the principal interest payment is $547. I mean, you pay that $1,200, you get it down to $531. So you save $16 a month. Woohoo! And that's why, like, 547, 531, $16 a month. The fact that you're paying a little bit higher interest rate, not that big of a deal on that itsy bitsy one. Oh, that's a good question, Jason. I never had anyone ask this question. Never had this question asked. I'm pretty sure the answer is no, but I'm sure it could hurt your score. I've had times where I was just doing stuff, right? Like purchasing property, taking out credit lines, just moving and shaking, like some people like to do, where I think I probably had 30 hard inquiries in a year, and that'll hurt your credit. I think it pulled me down to like, 720s, 730s. But it wouldn't be enough to disqualify you. If you actually opened up lines, that could be something. Maybe not though. Yeah, I mean, if you open up lines but didn't charge, so it didn't hit your DTI, like you could really, you'd probably get 50 credit pulls in a year and still qualify just fine. So I think the answer to your question is no. Oh man, you guys have got the questions tonight. This one right here is good. If you do a cash out refinance and take out a certain amount of equity, will that take away from the 250, 500K 2 year? You know what? It won't. And I'll tell you why. You bought the place for $400,000. Fix my pen. I have to write when I talk. I have no idea why. It just makes me think better. So you bought it for $400K. You owe $225, and you're like, you know what? I'm going to pull $100,000 out. I couldn't go that high. Pull $75,000 out. Cash out refinance. Now you owe $300. You sell for $640. Whether you owe $300 or whether you owe $225 doesn't matter for your tax exemption. Your tax exemption is what you purchased it for and what you sold it for. Bought for $400, sold for $640, $240,000 quote unquote capital gain that you're exempt from as an individual. And like you said, $250, $500 if you're a married couple filing jointly, you could have up to $500,000 in capital gains that you would essentially be exempt from paying if it was your primary residence. So whether you owe $100,000 or whether you owe $300 on that $400,000 property, or $650,000 property, it's purchase price versus sale price. It's those two that you're paying the capital gains on, regardless of what's owed. So that won't even be looked at. Oh, see, I see what you're working with. Yeah, what you have in equity isn't the question. That's not where the tax burden is going to lie. The tax burden is purchase price versus sale price. So you got to look at what you bought it at and what you're selling it at, and consult a CPA, because I don't want to be held liable. You're probably going to have to factor in if you've written off depreciation of that property. You might have bought it at 300, but then you've depreciated it. So that's like, brought that basis down even farther. And then when you sell, you're going to be exempt on the first 250 of it. Eddie True, you demand. Thanks for joining, brother. Oh, yes, sir. Yeah, I didn't want to talk smack about your beloved Hornets, bro. But I mean, I've learned just as much on YouTube that I did over there. Spent some fine years over at Sacramento State University. between 1998 and 2005 is when I graduated. And before you guys call me slow or, make fun of 7 years to get a degree, I went and studied abroad 3 different semesters, did 1 in Australia and 2 in Mexico. And so I got a Spanish minor, got a minor in international business, and got the 4-year finance degree. So I wasn't just messing around, taking my time. I was seeing the world. I was doing some things. Okay. That's why it took me 7 years to graduate. Stingers up. Stingers up, Dorian. Thanks for joining, brother. That's good stuff, man. For your teachers. It's funny how that happens. You can follow stuff on YouTube and be like, oh, I learned that from Graham Stephan. I learned that from Beat the Bush. I learned that from Meet Kevin, or the one you guys got or Jason, if you like business stuff, Alex Hormozy. He's relatively new in my ecosystem of folks that I watch, but he's got great stuff. He's the guy that did Gym Launch. I think he helps gym owners 10x, 20x their business. But it's good stuff. Jen coming with a really good question. Where in California are you looking for $150,000? That is a great question. I'm sure there's parts of California, and I think too, like there's like really desolate desert areas down south where you could probably buy for 150. If I thought about where you could buy for 150 around me, it's probably possible, but it's not a place you would be without a loaded gun and a couple security doors. So yeah. The rate's not going to be that much better. Yeah, if you did 10% down, yeah, you don't want to do less down than 20 because then you're paying mortgage insurance. So 20% is fine. And I would just say if you like, it's a $16 difference. I'm looking at the rate sheet still. Even if you paid 2 points, you get it down to 3 1/8. Now you're saving $33 a month, going from $547 to $514. The better plan, take the 3.6, take maybe the 3.5, apply extra payments towards it. If it's a manageable payment, which I'm hoping that itsy bitsy loan is, see what happens when you throw an extra $500 a month at it. You won't be worried about that interest. Could be paying that thing off quick. Oh, Regan, this is exactly what I'm looking for. Answer my question, ditch the bank, got with a local broker. This, I got to take a picture of this. I got to memorialize this because this is good stuff. And make sure I got that. My camera's in the way. Hold on. I'm hoping to have some impact on some folks. So this is all right. There we go. Smile for the camera, Matt. All right. Ditch the bank. We should start something. Ditchthebank.com. I don't know. All right. Jason's avoided taxes. Legally though, you're not cheating. You're just using a tax loophole that says you can have up to $250,000 in gains in your primary residence and be exempt from it. So good for you, Jason. Buddha. Hello, Matt. We'll get to the question part later. That's not in there yet. Kimberly. New home buyer, 2.5 years in. You want to know if property taxes ever go down. I think when the market was going down in 9, 10, 11, 12, the assessor's office was taking their sweet time, not lowering property taxes. You had to go like apply for it, right? In an appreciating market where home prices are going up, sure as heck, they're going to be increasing your property taxes every single year. Good news is in California, they can't increase it that much. It's just little increments going up. But I would not hold my breath for California to be on it. Like if the market flattened out, or 2 or 3 years from now, we start to see a small decline in the market, where they're like, oh, you know what? Let's rein those property taxes down. Let's bring those back down. I don't think I don't think that's going to happen. I mean, one, I don't think we're going to see price depreciation anytime soon. And if we do, I wouldn't expect California to bestow those savings upon you. They'll just continue to collect that revenue and then blow it on. Never mind. I won't go down that rabbit hole. Thanks, Jason. Appreciate you, man. Yeah, Alex Hormozy is good, man. Close enough. You wrote Hormosky, it's Hormozy. Either way, you'll find him. He's good. Yeah, I'll see you at the peak, brother. Good point on the PMI extra payments approach. I'm hoping to have some impact. I just realized that was a rookie question. No, they're all good questions. And the thing about it is what you think is a rookie question, other people are thinking and want to ask. So I appreciate you asking it, because all the feedback I get on all the people that are like, man, thank you so much. This helped, that helped. You know, somebody on here earlier mentioned that watching helped. The reason why it helps somebody is because the folks who are on here asking questions are asking the good questions to get the response that's going to help other people watching. All right. You buckle up, Buttercup. We'll be here for about another 22 minutes. I'm going to go about an hour and a half. Since my house is falling apart, I don't think I should go much longer. Get home to the wife and kids and make sure that no other ceilings have caved in tonight. All right. Nomadic, no war. I filed for forbearance and I wanted to do a cash out refinance. I heard something about waiting 6 months to do a cash out. You heard wrong. I've got plenty of people that came out of forbearance and we started a cash out refinance right away. So just know that, and this is good information for anybody. Different lenders have different, they're called overlays. So there's a set of guidelines we all got to follow. Fannie and Freddie set the rules. They say, here's what we want from a debt to income ratio perspective. Here's what we want months of reserves. Here's what we want for this. And then depending on how aggressive or how conservative individual institutions want to be, they can either say, okay, that's a fine set of rules. Anything that fits their rules, we're in. We're going to do loans that way. What the most conservative banks will do, let's use Chase for an example. I talked to somebody, they're like, they're not even doing investment properties anymore. No investment properties. And then they might say, we're only doing loans for 700 credit score and above. We're not going to do FHA loans. We're going to, even though Fannie and Freddie, this set of rules that's the bare minimum, says that we need 3 months of reserves for this type of loan, we want 12 months. And, things like that. And so all that to say, you might have had somebody say that is true for them and their operation. I can tell you as a broker, I've got plenty of lenders who are happy to do a cash out refinance as soon as you exit forbearance. Other lenders want you to exit forbearance and have 3 payments made before they'll even do a rate and term refinance for you. So keep in mind, different rules, different lenders. I'd be happy to chat with you. It's a good time to plug this in right here. GreatMortgageBroker.com. This is what I'm going to use for everybody. California, Arizona, Tennessee, Florida, Georgia, all the states. We're up to about 43. And if you go to greatmortgagebroker.com, tell me what state you're in, what you're looking to do. I'm either going to connect you with my California team, connect you with my Oregon team, connect you with my Ohio team, Colorado. We got teams all over, right? And so I can assure you, day in and day out, we've been working on lead intake, trying to get back to you as soon as possible, trying to connect you with people who can help you as soon as possible. I have literally, broke my back, blood, sweat, and tears for 8 years working on a stellar reputation. I'm not going to screw it up now. I'm not going to let you down now. So go to greatmortgagebroker.com, fill that out. We'll be happy to help. What other questions we got? I was poking around trying to find some mortgage news to share. Oh, you know what? If you're an investor, here's some good news. This rental aid that the government was, what was the number? Was it 60 billion? Finally, on a couple of fourplexes where I had some not so nice tenants. They could pay, they just didn't want to. Bunch of back rent due. The thing about it is you apply as a landlord, and my property manager applied for it. You have to have the tenant sign it as well. And, it makes the tenant current, it pays all their back rent. They can continue to live there. They don't get an eviction on their record if they're, all these months past due and they do end up leaving. And so anyhow, that money is finally, I swear this stuff passed like in February and whatever month we're in, October. But I just went past one of these articles, 2.8 billion in rental aid in September. Wow. So 510,000 American households were helped by the aid to pay rent, utilities, and arrears. That's just in September. 10.3 billion so far. That's pretty good. Pretty good. Yeah, see? Some acceleration of disbursements. California, just always the slowest. Don't let this fool you. Today it was one day out of the last 30 where mortgage rates got slightly better. So I am sure all these online mortgage lenders are going to be using that in their verbiage on their mass email. Rates got better. Oh, wow. We had a good day today. But it's literally like, remember how I talked about August 2nd? I'm going to show you guys something. Check this out. Check this out. I want to put it up right here. Yeah. This is going to be hard to see, but we'll try it anyway. Hopefully this screen is being shared. Let me see. Yeah, there's me. There's this. Okay, let me pull this over. This is mortgage-backed securities. And this is basically, since I talked about August, up here. August 2nd is the second candle, this green candle. Up here, then we see like a really nasty week. August 11th, we get the first bit of like, okay, a little bit of a rebound. And then kind of flat. And then this is late September when the Fed's like, hey, listen, in November, we're going to start tapering our purchase of mortgage-backed securities. This day, September 23rd or 24th, whatever day it was, was nasty. This is 103.11, 103.61, like 50 basis points in one day. Nasty. Then some flatness. Maybe you saw a little bit of recovery October 1. Bam, more red. Like, look at this downtrend. Like from here, 102.09, 104.25. This is 220 basis points, give or take, of worsening. And so, like I said, 0.3% to 0.5% in rate. As this stuff goes down, as these red candles go, this means rates are going up. And I don't know what anyone else is telling you, but I'm telling you, we got about 11 weeks of worsening with mortgage rates, and I think it's bound to just get worse. Okay, enough of that. Enough of my fear mongering. I'm just telling people I wouldn't necessarily wait if you have mortgage needs. If you've got a refinance to do, sooner rather than later. If you like it, lock it. And if you're going to purchase, you don't want to hastily purchase anything, but don't tell me I'm going to wait until next year because I think rates might be a little bit lower and I'll buy it then. Rates are not going to be lower next year. All right, Buddha. You want to refinance your house. You don't know if you're going to qualify. You owe $390. My credit not that good. I make about $85 a year. Can you help me, please? I'd be happy to help. Let's do some rough math. $85,000 a year. Let's call that $7,000 a month. That's good enough for government work, right? If your mortgage plus all your debts is under 45%, let's keep it under 45. You said your credit's not that good, so let's not stretch it. Maybe we want to be even lower. Times 45. That's $3,150. We want that mortgage payment and all your other debts to be under $3,150. If you're telling me you have a Corvette, student loans, credit cards, and other payments of $2,000, then you got no chance. If you're a more responsible young man with less debt, I'm sorry, I shouldn't say that. I shouldn't judge and I shouldn't assume. If you have minimal debt and you owe $390 and wherever you're at, there's not super high property taxes, you're probably in good shape. If you've got $1,500 to $2,000 in debts, then it's just not going to be possible. I mean, even if you got $1,000 in debt, it's going to be tough. What we want to solve for is we know we can get the principal and interest payment on this $390 down with a refinance. But what is taxes and insurance going to be, right? Because that could be super high. I mean, it could be in Alabama. It could be next to nothing. Or it could be where's high property taxes? Like New Jersey? Could be New Jersey. It could be a lot. $390. I just want to see. Just a random price, just so I can see the principal and interest. All right, let's pretend. I mean, your credit's not that good, self-admitted, right? So maybe you got a 3.25% interest rate. That's $1,697 principal and interest. Live in a place where tax and insurance are $500. Let's call it $500. So that's $2,200 on a mortgage payment. It only leaves you about $950. And we haven't established how bad your not that good credit is. $580, you're in trouble. Not so good, $664. Yeah, right. So you got a chance. go to greatmortgagebroker.com, fill out that form, and we'll take a look. I mean, it never hurts to try, right? Corey Brunson, how often do you get a nasty email from a borrower? Not that often. I mean, I think you would think that as much as we do, we'd get more nasty emails, but I think that me and my team are all aligned with, like, we're on the borrower's side. We're always trying to do what we can. And really, I've got a really smart team where we're doing a lot of the work up front. We're not going to be surprised and have stuff called for from an underwriter that's not something we can get. Knock on wood, very, very rarely we're going to have a loan turned down, because we're going to be able to identify that up front and tell somebody, hey, listen, we just can't get a loan done for you. If we scrub it and my production manager, my processor, my team says we're good to go, we're generally good to go, unless the borrower's hiding something, right? And so there's going to be very few instances where we get like a no, like a decline. In the cases where we do, on refinances, we might tell the borrower up front, we don't know if this is going to work. Let's submit it. Let's give it a try. Let's get your file underwritten before we even order an appraisal and spend money there. So anyhow, that's that. Miguel Ochoa, man, I wish I had as much energy as you, man, to chase deals. You're an absolute animal out there, bro. Slow down for a minute, dude. Great to see you, man. Thanks for joining. Appreciate you. Appreciate you doing business with us. I don't know if you've got the invite yet to the grand opening, but you're invited, man. November 19th. Let's do it. All right. We're closing in on 7:30. 7:30 my time. Yeah, no problem, Buddha. You got exactly 7 minutes and 25 seconds. Last call for questions. Now everybody's joining. Now we got 40 people on the live stream. I don't know where you guys were at earlier. We were just rocking and rolling. Maybe it takes an hour and a half for YouTube to recognize we're doing good things and start pushing this out to people. I will, since I haven't yet, ask you guys to smash the like button for the YouTube algorithm. That's a nice thing to do. Let me see. Let me see what we got as far as likes go. 16 likes. You guys can do better than that, man. If you do nothing else, just a free like. The free like would be very nice. Would be much appreciated. All right, now we're at 18. Now we're cooking with hot grease. I think we're only about 285 people away from 10,000 subscribers. If you do nothing else, just a free like. There we go. See, I pulled it up so I could see how many likes we got. Share this channel with somebody who you think might benefit. If you know somebody who's new to real estate, new to the home buying process, and they're just talking to you because they're saying, yeah, I think I'm going to buy a house next year, turn them onto the channel. I personally believe that empowering people through education helps. It helps the buyer become more comfortable who's brand new. You might be a fourth or fifth time buyer like Miguel Ochoa, and you're still learning stuff because it might help you on the next deal. Or it might be something that, you didn't necessarily know before, even though you've been exposed to real estate. You've done plenty of mortgages. You know your way around the real estate investing arena, but you might pick up some new tips and tricks, right? So yeah, I would love to see a new wave. First-time home buyers, first-time investors, jump on here, ask questions. A lot of people earlier were saying, hey, this might be a silly question. I promise you, none of the questions are silly. The questions that probably help the most are the ones where it's like, man, this is something that I don't want to ask because it seems simple, right? Those are the ones that undoubtedly, somebody's watching in Arkansas. Somebody's going to watch this on replay and say, oh, I'm glad he asked that. Tanisi, just not wanting to get too many hits on my credit report. Is that why you were saying you didn't know if you wanted to restart the loan or something? If you have multiple credit pulls within a 60-day window, some people say 30 days, but I've heard it's 60 days. It's going to show up all as one pull. So you can have an original pull, you can have a different lender pull it, then you can have, the original lender pull it again. It's all going to show up as one pull, not going to affect your credit like it would if those were 3 separate pulls, one at Best Buy, one at the car dealer, one at the mortgage broker shop. Dorian, I appreciate you, man. Let me know how else I can help you personally. I'm happy to. Oh, shoot. You got to get in here, dude. You got to get in my office. I've got the Gary V poster. Used to be in my background in my old office, and there's no room for it. You got to come get it. My wife is going to trash that thing, bro. So text me and get in here and pick it up. It'd be a good excuse to come by and check out the office. All right, Corey. It's a good question. If rates run over 4%, do you think ARMs might make a comeback? I don't know. I mean, a lender's going to really have to want to do ARMs is the problem. Because if I look at ARM pricing right now, we got somebody who's, 3.25, and I tell them, hey, I can get you an ARM, and it's 3 1/8. Like, why bother? For 0.25%. If they go up to 4, and it's like 4 1/4 versus 3.875 or 3.75, maybe. But I mean, my experience when these ARMs came out and more people were looking at them, I just got people that are like, nah, I'm good. If you've got a real estate investment that's a long-term hold and you got to bother with that thing in 5 or 6 years versus just set it and forget it, not worth 0.25%. Even on your primary and whatnot, like, people have learned, if nothing else, through these last 18 months that you never know what to expect. And the problem I see with adjustable rate mortgages is mortgage guidelines change. People change jobs more than ever. So to be stuck in a position where you're not able to qualify to refinance out of a adjustable rate mortgage is enough of a risk for the people to say, nah, not even going to consider it. If it's 0.25% better, not even going to entertain it or run the numbers. If we're talking about 5% versus 4% and it's a 1% difference, then we can talk about it. Even me personally, I feel like I'm a fairly low risk to lenders. I haven't put myself into any ARMs, and they've been available. And so yeah, I think that rates would have to go above 5, Corey. And there would have to be a spread between ARMs and 30-year fixed of at least 0.75 for people to go, all right, let's take a look. That's just my personal opinion. All right, you let me know, man. The next 2 days are good. I'll be in this office all day. All right, Jason, final question, then I'm getting the heck out of here. Currently house hacking, when getting a second rental, how will my finances be assessed? Would they both need to squeeze into my debt to income? Yes. But here's the thing. You're going to be moving out of this first one, and you can use departing rental income. So here's how it would work, Jason. Let's do easy math because it's too late and I'm too tired. You make $10,000 a month. This current place you're living in costs $2,500 a month. The new place you're buying costs $3,000 a month. And before you're like, oh shoot, that's $5,500. I make $10,000, 55% debt to income ratio. No, it's not going to work. If the place you're leaving can rent for $3,000, you get to add that to the income side. You just have to multiply it by 75%. It's a factor to factor in expenses, which you're going to have. So you can add $2,500 to the income side. Now you got $12,500. Let's say you got no other debt. So that makes $5,500 your front end and your back end. 5,500 divided by 12.5 44%. Ooh, that's too high of a front end. That deal's dead. Let's make your first mortgage $2,000 and your new one $2,500. Same rent numbers, same income number. So now we got 12.5 versus 45. Voila, 36% over 36%. Good credit. That one probably works. The end. You qualify. You're approved. Your real estate empire continues to build. You become a multimillionaire, travel the world, and enjoy. The end. All right. Thanks, everyone, for joining. I truly appreciate it. Just want to throw these up real quick in case anybody missed it. GreatMortgageBroker.com. This is where you go, no matter what state you're in. If you want me and my team to help you out, GreatMortgageBroker.com. I promise you, it's quick. 6 quick questions. You'll be connected with us. We're happy to help you out. Here's the link to the course. I know some people like to give themselves incentive, right? If you're like, you know what, I want to learn Mortgage 101 and I want to know the basics so I'm better prepared for mortgages in the future. By spending $97, you're going to force yourself to watch these videos. And these are a collection of what I deem to be the most important stuffs. And I put it all together and did a course. So anyhow, I don't ever push that, but I decided why not? You know, tonight's the night. Maybe somebody needed to hear that. So until next time, I appreciate everybody who joined. Next time, bring a friend. Let me get to Lion Tiger before I want to just leave this question hanging. Need some advice about buying a house I'm actually renting. Ask the owner to buy from it. Is it better to get a pre-approval from a bank or a mortgage broker? I am glad you asked this question. Where did it go? I took a picture of it. Somebody was so happy they got away from the bank. You got to talk to a mortgage broker. That's all there is to it. Mortgage broker is going to be better, faster, cheaper. It's not talking bad. Banks are just good at some stuff. Mortgage isn't one of them. Yeah, go to GreatMortgageBroker.com. Fill out this 6 little questions. We'll get you straightened out. And I promise you, this is really common in the market we're in, buying directly from the seller. If you've got, 2 parties at amicable, you might want to bring someone in to help with the contracts and whatnot. Not always necessary, but sometimes useful. So anyhow, me and the team are happy to help advise you no matter where you're at. If you're in a state that for some reason we don't service, I'm still happy to give you good advice. So thanks everyone for watching. Until next Monday at 6 p.m. Pacific Standard Time, I am out. Hope this finds you well. Hope this helped you in whatever, real estate journey you're on. Thanks. Bye-bye.